Welcome to The Anatomy of a Bank Run, a comparative analysis of the collapses of Silicon Valley Bank and Yes Bank. Both suffered devastating consequences, triggered by different factors. SVB was hit by a liquidity drain, while Yes Bank suffered from corporate governance failures and loss of depositor confidence. We use a strategic analysis matrix to understand the anatomy of a bank run. It focuses on four elements: the catalyst or trigger point, the balance sheet flaw or structural weakness, the flashpoint or decisive moment, and the intervention architecture for resolution. The core vulnerability lies in the corporate flow, specifically the tension between fractional reserve banking and the liquidity mismatch. This gap occurs when short-term demand liabilities significantly exceed readily available liquid assets. At its zenith in late 2022, SVB was a major player. It had total assets of $209 billion, making it the 16th largest bank in the U.S. Crucially, it dominated the venture capital ecosystem, banking with over 50% of all U.S. VC-backed tech companies. In late 2019, Yes Bank was India's fourth largest private sector bank. It had high-velocity network connections, especially to mega conglomerates in real estate, infrastructure, and non-banking finance companies. Macroeconomic conditions from 2019 to 2021 enabled network density. Near-zero global interest rates led to record VC acceleration and significant Indian corporate credit expansion. This created a highly leveraged environment for both banks. A key fragility was deposit concentration. SVB had an extreme reliance on the tech and VC sector, with over 85% of deposits coming from this segment. Yes Bank's fragility was its structural dependence on bulk corporate and wholesale deposits, which accounted for over 75% of its total deposits. Both banks suffered from a severe asset-liability mismatch. Their liabilities were composed of instant maturity, short-term demand deposits. Their assets, however, were concentrated in long-duration, illiquid fixed income or loans, creating a fundamental duration risk. SVB saw massive deposit growth, increasing from $61 billion in 2019 to $189 billion by the end of 2021. Management chose to lock down over 90% of this cash into long-term, fixed-rate hold-to-maturity, or HTM, mortgage securities, creating extreme fixed-income exposure. The consequence of rate hikes was the causal link to duration risk. The Federal Reserve's aggressive rate increases caused the existing fixed-rate bond market value to plunge, leading to massive unrealized losses in SVB's HTM portfolio. Yes Bank's asset concentration risk involved its corporate loan exposure. The bank had over 710 billion Indian rupees exposed to its top four mega conglomerate borrowers, many of whom were already showing distress markers and were in the process of liquidation or default. Yes Bank masked its true asset quality through quote-quote loan evergreening. While formal disclosures reported low non-performing loans, the bank was granting new loans to repay existing defaulted ones. This systemic loop perpetuated the hidden default cycle and magnified the realized distress exposure. Yes Bank's collapse was further accelerated by systematic failures in governance. This included unchecked promoter power dictating strategy, board complacency that failed to challenge decisions, and systematic overrides of internal risk management policies. The silent crash points highlight how seemingly adequate capital disclosures masked massive unrecorded losses. For SVB, this was $15.1 billion in unrealized bond losses. For Yes Bank, it was a massive audit divergence, wiping out net capital and pushing them below regulatory floors. Both banks exhibited distinct systemic risks. SVB fell victim to, quote, the investment trap, locking cheap deposits into illiquid securities. Yes Bank suffered from, quote, the funding gap, where aggressive loan growth outpaced its sustainable deposit base. Both eliminated critical liquidity buffers. The dual timeline reveals the key catalysts. SVB's crisis was an instantaneous depositor confidence drain, driven by financial announcements. Yes Bank's was a slow-motion investor confidence drain due to regulatory audit revelations and asset quality concerns. SVB's collapse followed a chain of transactional steps. The tech downturn led to startups withdrawing cash, forcing SVB to sell bonds at a loss, realizing $1.8 billion. The failed $2.25 billion capital raise announcement triggered mass panic and receivership. Social media dramatically accelerated the crisis. A primary impulse on X/Twitter quickly propagated through private Slack channels, creating a multiplier network. This instant panic led to $42 billion being withdrawn in just 10 hours, creating a digital bank run. Yes, banks' descent was a multi-month erosion of liquidity. It started with rating downgrades, followed by wholesalers withdrawing institutional funds. This led to an inability to raise global capital, and eventually, core capital adequacy dropped below regulatory minimums. The crisis quickly spread through a systemic contagion network. Distress at the central institution triggered credit defaults and forced asset sales across independent asset managers, mutual funds, and smaller regional banks, demonstrating intricate interdependencies. Both collapses highlight the fragility of uninsured deposits. SVB had over 90% of its deposits above the FDIC insurance limit. Yes, bank also had a massive volume of corporate deposits exceeding its deposit safety limits, amplifying the risk of flight. The market reaction was swift. Following the public halts of both banks, there was an immediate and sudden spike in risk premiums. This was reflected in the widening of interbank lending spreads and credit default swaps. Central bank interventions differed significantly. The U.S. leveraged a systemic risk exception to protect depositors. India implemented a comprehensive reconstruction scheme focused on equity injection and mandatory institutional investment. The U.S. intervention was an absolute closure of SVB. It included the eradication of equity holders, activation of the systemic risk exception, and a full 100% backstop of all uninsured deposits. India's response for Yes Bank involved the RBI suspending the board and placing a moratorium on withdrawals. A consortium, led by the State Bank of India, was then assembled to inject fresh equity. The reconstruction scheme mandated the State Bank of India to acquire a 49% stake in Yes Bank. Furthermore, institutional equity investors were subjected to a mandatory 3-year lock-in period. A major component of Yes Bank's resolution was the write-down of additional Tier 1 or AT1 bonds. This measure led to the complete write-off of over 8,400 crore Indian rupees in AT1 bonds. Regulatory focus has shifted to architectural reform. The U.S. is reviewing regional bank oversight under Dodd-Frank. India is enhancing its prompt corrective action frameworks and strengthening digital liquidity monitoring. There is a push for proactive liquidity monitoring. This involves continuous, automated surveillance of net stable funding ratios. It also includes automated alerts for unexpected deposit outflows, especially across concentrated corporate segments. Future risk management requires a more granular audit of deposit quality. This involves evaluating granularity versus wholesale concentration, average account size, and the interconnectedness within specific sectors like tech or real estate. SVB's collapse demonstrated the risk of leaving long-term fixed income investments unhedged against rapid changes in macro interest rates. Duration risk must be actively managed. Regulatory capital requirements are under review, especially concerning how large institutions strategically structure operations to bypass specific oversight thresholds. Stress testing guidelines are also being enhanced. A crucial formula for understanding liquidity is the net liquidity position. It calculates the ratio of cash and unencumbered liquid assets to total demand deposits multiplied by a concentration factor. The behavioral cycle of a digital bank run is rapid. It moves from a social media alert to a loss of confidence, leading to instant, app-based capital flight and potential systemic collapse. In conclusion, proactive risk management requires a focus on structural duration risk, corporate governance, granular deposit quality, and resilient institutional financial analysis.